Hey everybody, welcome to this free edition of our Trader User Group weekly roundup for the trading week ending August 6th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is low rates, high inflation. What's next? Well, let's kind of take a look at where we've been first, and then I'll kind of delve into some of the charts that show some interesting relationships and where we could possibly go from here. So, first thing I want to do is let's go over and take a look at the index performance for this past week. As you can see, everything was in the green for the week. The Dow, the S&P, Nasdaq, and the Russell all in the green. Year to date, very strong, double digit year to date returns, all of them having a very strong year. A lot of this is the bounce back from COVID last year, obviously, but still very strong. S&P's leading the way at 18.12%, bringing up the rear is the Russell. If we look at the forward PE ratio, it's 22.37. That's still higher than the 5 and 10-year average. Very rich markets. That means the markets demand and expect high earnings per share and strong economic data out of corporations and the economy. And that's kind of what's priced in right now. So you've got a high benchmark, high hurdle rate that you've got to overcome. So it gets harder and harder, kind of like a tractor pull for all you rednecks out there. 10-year treasury yield 1.29%, lower than the S&P dividend yield of 133 by 4 basis points. So that basically continues to put money in the S&P. Current VIX volatility, it closed out the week at 16.15, a lot lower than the prior week's close at 18.23 by 11.41%. So even volatility is starting to come in a little bit. That kind of helps calm the markets. Now, keep in mind, this is the month of August, which traditionally has been a very volatile month for the markets. Everybody's on vacation. Trading volume is a lot lower. Markets tend to bounce around a little bit. And remember, I am still on record as saying a little bit of a pullback. Now, I was originally at 7 to 12%. I'm capping it back at about 5 to 10% right now. There's just so much money in the market, so much liquidity, so much stimulus that, if you've heard the term, you can't fight the Fed. That's kind of where we are right now. And if we look at sector performance for the week, no doubt the financials did very well for the week, all the banks. 3.67% for that sector for the week. Bringing up the rear was Staples, 0.86%. Typically in the staple sector, you get the companies that pay more dividends, more value oriented. This was the week of growth. Energy for the year up 33.37%. Staples bringing up the rear, although in the green for the year, 6.43%. Okay. Now, if we look at the economic data that came out, strong week. Now, we ended it off all-time highs in Nasdaq, S&P, even the Dow managed to make new all-time highs for this week. Friday's job numbers were unbelievable. Okay, employers add slightly under a million jobs in June, 943,000 to be more accurate. In addition, April and May's were revised a lot higher, and the labor participation rate ticked up along with average weekly hours worked. Okay. In addition, we got the unemployment rate falling to 5.4%. That's a new pandemic era low. The ISM, Institute of Supply Management, came out with their July factory activity. It showed growth at 59.5%. Anything over 50 shows expansion of manufacturing activity. So that's very strong. And we also had June factory orders surprise to the upside at 1.5% versus an expected 1%. Okay. So, and then finally we got ISM service sector. That jumped 64.1%, or 64.1 rather, above expectations of 60.5. So a very strong week for economic activity, strong earnings growth, all-time highs in all indexes with the exception of the Russell, which is mostly small cap. Very strong week, right? Now, And that was pretty much around the economic data. If we look at the US Treasuries, no doubt when you get that kind of strength in economic activity, it does tend to move Treasury yields up, which is what we saw. Treasury yields jumped on that jobs report. We're starting to get some more hawkish comments out of the Fed governors and the Vice Chair Clarita. So that's going to put a little bit more pressure on the rates. We did see the 10-year Treasury finish out the week at 1.29%. And while low, it was up for the week. Now, when interest rates go higher, that is why you see there the best performer for the week was financials, because they love higher interest rates. That's how banks make their money. So we got some all around a very, very strong week. Now, if we kind of jump across the pond and go to Europe, and let me just show you the index of Europe and how they fared, you can see the Euro stocks, which are the 50 largest companies across Europe, up 2% for the week. Very strong year-to-date performance. Same thing with the FTSE, which is the London index, CAC 40, which is France, DAX, which is Germany, all of them in double-digit growth year-to-date. Strong week all around, okay? And if we look at Europe, we got core Eurozone bond yields. They did, unlike the US, trend a little bit lower as Europe is more sensitive to COVID cases than we are here. They tend to be more quick to shut things down. So it kind of fuels some doubts about a wider recovery across Europe, some countries getting hit harder than others. We did get the Bank of England last week talk about their policies, and they left their monetary policy and quantitative easing program unchanged, which no one expected them to change it. But they did come out, they said that interest rates are probably going to rise from 10 basis points to 20 basis points in 2022. So in the scheme of things, that's really nothing. And even up to, hold your breath, 50 basis points all the way out to 2024. Now, how these idiots can forecast that far out in time when they generally have a hard time forecasting 90 days out in time is beyond me. But that's what they came out with, and that's how markets price action, right? They also updated their forecast for inflation. This is the UK, right? To peak at 4% either late in this year or early next year. And then they call for it to moderate. They do call for their economy to grow at 7.25% this year. But they also increased their forecast for 2022, the GDP, to go up to 6%. Their previous forecast was 5.75. And we did see across the Eurozone as well, the PPI, the producer prices, they rose 1.4% in June, which is in line with higher inflation, right? And they got a surge in energy prices as everybody's getting worldwide right now. So we're getting some strong growth out of Europe. So it's no doubt that everything in Europe closed in the green for the week, year to date, very well solid in the green, okay? And if we look at the only country of the G7, that would be the 7 largest economic countries in the world, the only one where the IMF downgraded their growth prospects for 21 this year was Japan. All right, they said it reflects a tighter COVID restrictions because Japan seems to be getting hit very hard with COVID. I guess the Delta variant or whatever the heck they got. So IMF has reduced their growth prospects for this year. And they project Japan's growth next year is going to be 2.8% year over year. And that's down from 3.3%. So Japan is having a harder time of it. But you can see the Nikkei, in spite of all that, excuse me, finished the week at 1.97%. Year to date, just barely above zero, 1.37. And then, of course, over in the other Asian markets, China and Hang Seng, which is Hong Kong. China, their official PMI reading in July pointed to slower growth, okay? And both their manufacturing and services sector. They're having some more outbreaks in COVID also, so they're shutting down some things over there in China. But the bigger story with China is they're just coming down really hard on their tech industry. And that's why year to date, both Hang Seng and China are underwater year to date. I mean, look at the disparity between the European markets, the US markets year to date, and the Asian markets, even Japan. That's only barely above zero at 1.37%. So really having a hellacious time of it in my mind. Just really hard moving forward. Now, when the US markets start, or if they start raising rates, which they will, they start cutting stimulus, which is another form of raising rates. And if they go after the tech industry, we can expect some of that on our shores as well. Okay, so just so that you understand. What I'm going to do is shift the screen over here real quick. So let me come over. Let's take a look at the charts, kind of see how they're shaping up here. We're going to start off with the U.S. markets. Obviously, we're going to start off with the S&P 500 E-mini futures, which basically tracks the S&P. And you can see we're at all-time highs. Okay, you can see this red line, which is the 50 EMA, exponential moving average. We're well into a bullish market here. Even they go a little bit of a divergence here. Every dip is no more than 3%, 2.5% or 3% max, and then we bounce back up again. So we've got a strong buy the dip crowd. Eventually that will go away. For you members, once we get that next dip, and we will get a dip, a small dip, 1 or 2%, I will let you know if it's a buy the dip or sell the rally kind of endeavor. But right now it is a buy the dip. Okay. If we look at my specialized index, which is a combination of Microsoft, Facebook, Apple, Netflix, Google, and Amazon, this index here just comprising those guys. And I got a weighting factor against the cheaper stocks so that we can throw in Amazon and Google. It had an all-time high back on July 28th. Towards the end of July, it pulled back a little bit once their earnings came out, right? They had knock your socks off earnings. But again, when expectations are, up in the stars, you got to really, the sun and the moon and the stars have to line up across everything. Otherwise, they cut you back just a little bit. But they're still in a bullish mode, as you can see by this index chart here. We're getting a little bit of divergence here. Now, remember, as we move higher and higher, the markets are guided higher by fewer and fewer stocks. That is normal. But when those stocks that are moving higher start giving it up, if it's not picked up by other stocks that were not, doing very well, then the markets give us a bigger dip, and a possible correction. Right now, we're nowhere near that, right? Just so that you know. Just show you the China stock. This is the ETF that tracks China. We're off the 2021 low, which was a formal bear market, but then we moved back up, but we're still below zero. You can see that blue dashed line separates being in the green or being in the red for the year. Not a very good sign. Now, I think the bottoming process in China is about done. So for those of you, and we've had some members come in and play some of the ETFs that are looking for hard moves higher, but be careful of a rollover. That would be a bull trap, which means it traps you into thinking it's bullish and then it rolls back over again. Okay. So you have to be very careful of that. And of course, if we look at EEM, which is emerging market ETF, you can see here it's the same thing, right? Any rally is not sustainable and we roll right back over again. So again, there's still a lot of issues in the Asian markets, and that's affecting emerging markets because that represents, this ETF represents about 35% of China. So wherever China goes, EEM tends to follow, right? If we look at the small cap index, this is the one bringing up the rear. It's still in the red for the year. In the green for the year, 13.75%. But you can see how we're in this wider zone. We finally, on Friday, and this is the first daily close above the 50 EMA going all the way back to July 9th. All right, so let's see if we can hold this. If we can hold it and get some attitude or altitude and some escape velocity, perhaps we can get outside of this shaded blue zone here and move higher. All right, the last all-time high in the Russell was way back over here on March 15th. And then it's just been porpoising sideways. Okay. This could be a sign that we're in a big consolidation period and we're going to move higher. And then the SPX, the Dow, and Nasdaq are going to move much higher, or we're going to just give it all up. And we've already seen the highs are pretty much darn close to the highs for the year. Okay. I believe we still have some more upside to go for the year, although I am still looking for a little bit of a dip. And it could be a correction, but clearly a dip or a pullback of 5 to 8%. And that would represent a great buying opportunity for us. And then we're just going to jump in and take the run. If we look at Nasdaq, that's the Nasdaq 100 futures, 100 of the largest tech companies. You can see here we did make an all-time high here on Thursday, and then we just pulled back just a little bit, but we're still near all-time highs, still very bullish, right? If we look at volatility, you can see the vol came in pretty strong on Friday on that jobs number. It's working its way back down here. Now, we have not been in the green really since the pandemic. The green would be the VIX below 15. Every time we get down here, we find something to spike us up. So that tells me that there's still a lot of nervousness in the market, expecting a little bit of a pullback. Okay. So this is something that we've got to follow very closely. And of course, if we look at treasury yields, look at bonds, guys. On Friday, it really came down hard. Now, as I've been saying, up in this area up here, you want to be more seller of bonds than a buyer of bonds, with the idea of, now my target for the bonds actually was down here by the end of the year. That would suggest interest rates are going to go much higher by the end of the year. I think it's a good longer term bet to play. If we do get that pullback, interest rates will go lower, bonds will go higher, but use that as an opportunity to sell the rally, not buy the dip. I think this is going to go lower. Okay. I think it's going to come down, probably challenge the 50 EMA and then go lower. So TLT puts, if you look at TLT here now for the members, I've been suggesting this to them. The TLT, look at the gap down right there. TLT goes in the direction of bonds, right? Goes in the opposite direction of interest rates. So trading this to the downside, in fact, my target on TLT by the end of the year is in the low 120s. It's at 147. That would be a great return, picking up some puts. All right. So members, we'll review this Sunday evening and get a little bit more detail on it. But that's a little bit of what I'm looking at in the treasury market. The U.S. dollar index, it's very strong. You could see that test of the 50 EMA and the 200 EMA. So I think this can run up higher, and then we're going to get the rollover. That's what's causing agita in the precious metals market like gold and silver. Gold really gave it up on Friday. Gold is not like a strong economy. It likes it a little bit weaker. There will be an opportunity for us to really make sunshine and make some Benjamins in the future on gold. Right now, no. It's just running sideways, slightly down. Okay, and when the dollar goes up or the dollar index goes up, we know the euro goes lower. And you can see the euro coming down in these levels down here. I'd like to see it go even lower. Makes it cheaper for me when I go to Europe. But once it gets down a little bit lower, then we're going to play the euro to the upside. Okay. So if we look at gold, speaking of gold, 45 points down on Friday. Look at that move right down to this trend line here. If we step it out, you can see on this weekly chart right here, it's a symmetrical triangle. We've tested it several times. This would suggest gold is going to come back up in here. If we break this to the downside, it could run very quickly down to about 1674, 1675. Okay. And then get into another longer term chop. Let's see where this goes. Okay. But gold is just, it's not going to perform right now. All right. We got a longer term upside play in gold. But right now, it's not a trade that you want to be playing, all right? Not to the upside. If you are playing it to the upside, like we are, we're doing it in a way where our downside risk is relatively small, okay? So that's just kind of how we're doing that. And then, of course, if we look at copper, longer term, copper is going to be pointing up. You can see that upsloping trend line where we come down and we test it. I think we may test it again. Remember, if we do get that dip, or a pullback in the markets, copper will go down too, because copper is called Dr. Copper. It tends to go where the global growth is projected to go. So when you get growth projections, stronger growth projections, it tends to move copper up. The other thing that's helping copper is EV, electric vehicles. The more requirements governments place on car companies to come out with a higher percentage of EV autos, that puts a greater demand on copper because copper is a building component to batteries and the EV market. All right. So that's going to continue to put a bid underneath the copper market. Okay. And then, of course, if we come over here and we look at oil, you can see oil right here had a very strong week. or it had a strong week. Yeah, it a little bit weak towards the end of the week. You can see boom, boom, boom. But like I said, once you get up this level up here, you want to fade the move. You want to be doing condors, call condors. I like better than put condors because the odds favor oil to just run sideways for a while. So we got some members playing these. That's the way to go. Okay. I mean, you just want to do that. Now, a couple of other things I wanted to show you. If I show you some ratio charts, if we look at growth versus value, you can see this chart has just been going straight up. That means growth has been outperforming value stocks. Now, when does growth outperform? You got low interest rates, you got a lot of stimulus. Growth stocks tend to be the place where you want to park your money. So growth stocks would be like technology, anything that pays lower dividends, but it's you're paying a high premium for the stock because it is growth, a high PE ratio. But with low interest rates, it loves this kind of market. If interest rate starts riding higher and you start getting a more hawkish Fed, which I think we're going to be seeing shortly, then that's going to tend to subdue growth and increase value. All right, so that's a little bit about what I'm seeing there in growth versus value. Okay, and then of course, if we look at debt versus equity, that would be. Let me just see if I can find this one on here. Here we go, right here. This chart right here, you can see we started moving higher, meaning interest rates and debt, money was going into debt out of equities. And now it's starting to reverse again. When it goes lower like this means equities is where you want to be. When it starts going higher, that means money starts coming out of equities and going into debt. It's kind of a risk off environment. I mean, you can just see this right here, just amazing move, right? We finally broke out of it and we had this a little bit of a move higher, but I think it's going to move back down again, right? So if we zoom back in on this chart, you're going to see that money is still coming out of debt into equities. So that's kind of a hint that we still got some growth ahead of us. Now, as we finish our earnings over the next week and a half, and then we wind down our Q2 earnings, it's going to be real quiet until we get the Fed at Jackson Hole, Wyoming. That's when all the muckety mucks, the head muckety mucks of the muckety muck factory, that would be the Bank of England, the ECB, the US Fed, and Bank of Japan, right? Bank of Canada, those guys. I throw them in there, but they don't really count. They don't really move the markets that much. But either way, all the muckety mucks get together and kind of come down with their tablet and say, this is what we're going to do for 22, 23, 24. They never get their prognostications right, but it doesn't matter. Whatever they say, it's how they're going to control the money spigot, and that's where the money goes. So we do have the propensity in the end of August after that meeting to see some reason for a dip, profit taking, but I think it'll finish off strong for the year. At least that's the way it's looking right now. All right, everybody, have a really great remainder of the weekend. Members, I will see you this Sunday evening for our weekly market watch. Have a really good one, everybody. See you guys later. Ciao now.